In this week's update, market realities bite, valuation reset. Time to move up the quality scale, and no precious metals reversals yet. My name's Garry Davis. I'm an authorised representative of Primary Securities, and the information presented here is general information only. Last week, I sent a message about how I was seeing things unfolding. I was getting a bit nervous about the way that many stocks were starting to behave. There was certainly more than a whiff of a change of character. So just to recap on what I said last week, that you really should be just a bit beware of what might happen, because there was no allowance for what might go wrong. The US market was, on any normal metrics, was fully valued. So many stocks were stretched that it wouldn't take much to break the rubber band. I said that care was needed, so hopefully viewers of this video took note of that. We introduced tighter stops in the Insiders Club, and that certainly would have benefited members, particularly on Friday night, when the US market did sag quite sharply in the last hour. I went on to say, stay with upward momentum while it prevails, but know what your exit strategy is, know what your purpose is, know what your exit triggers look like. And if you don't know what your purpose is, and you don't know what your exit triggers look like, then how can you possibly make decisions, sensible decisions, about whether to stay with a particular stock or get out when faced with the sort of volatility that we've seen in the last week? There were some very savage moves, particularly in Australia, stocks reporting, and the moves were extreme, and some of them were unwarranted based on fundamentals, and therefore the price is likely to bounce back fairly quickly. How can you make a decision about whether to stay or whether to go if you don't know why you're in that particular stock and what your exit strategy looks like? And that's what we spend a lot of time. It's the single biggest focus in the Insiders Club is on risk management. So very important. Now, rolling on to this week, price action deteriorated badly. There is a but though, or there's a couple of buts, so hang on for that. Has the gloss of Trump's victory and everything that he's doing, all the changes, is that wearing off? Don't know the answer to that, but it's possible. There's been a very upbeat corporate mood since the start of the year, but this seems to have disappeared. The outlooks, the rhetoric, just seems to have shifted in the last week or two. Add on to that, we've got consumer surveys now showing that consumers are now wary. They don't know what the impact of tariffs is going to be on the price of things that they buy. And then, of course, we've got this whole uncertainty about tariffs, and markets hate uncertainty with a passion. Markets would much prefer to have a known negative than to have all this uncertainty. And so it hasn't made sense to me for a couple of months that so many stocks were trading in the US as stretched as they were, given that the market hates uncertainty. That just didn't line up for me. And that's why I put out that message that I did on the prior Sunday. But look, overall, this is still a bull market. And so therefore, significant pullbacks in stocks are likely to throw up some very good buys. However, there's lots of buts here because we've got a lot of uncertainty. It just got harder. I think we've had the easy part. January and most of February, I think, has been relatively accommodating for many stocks going up. But I think it just got harder. You've got to be more selective. You've got to have more of an eye to valuations. So I think the market is probably, particularly the US market, is entering a period of reset. Now, is that a little bit of reset, or is that a bigger amount of reset? No idea. Just play it as it comes, manage risk, understand your purpose, understand what your exit triggers look like, and just take it from there. I expect that the percentage of runaway winners, and there's been some incredible ones, there's been hundreds of them in America. If you do any kind of scanning work at all for new 52-week highs, there's been some just extraordinary breakouts and surges, I think the percentage of those runaway winners will drop quite dramatically. It's been a period of great momentum, but I think you're going to have to be a little smarter, a little more patient going forward from here, and definitely move up the quality scale. If you own low quality stocks, they're going to get treated very, very harshly. The market will be totally intolerant of stocks that don't have a fair degree of certainty around their outlook. So you definitely need to move up the quality scale. But having said all that, it was February options expiry. And we know that market makers can have a habit of, let's call it, engineering certain price drops, particularly with stocks that have been running hard. So I wouldn't dismiss the impact of February options expiry, and particularly the fact that a lot of the move on Friday occurred in the last hour. In fact, if you look across the whole shortened week in America, it was only a 4-day week. Up until the last hour or two in America, the market was actually going along quite well. So my comments are sort of hedged a little bit by the fact that it was options expiry, which can create some price movements that are actually meaningless. For those of you that don't understand how the options market works or why it works, it is more than probable that some of the moves, some of the extreme moves, they were just window dressing, if you like, window dressing for the market makers. So that's the backdrop to what happened during last week. And as I say every week, it's easier to lose money in the stock market than it is to make money. And we're entering a period where that is going to be even more so. The critical elements are to understand why you are buying something, and your purpose for buying a particular stock can vary. Every stock can have a different purpose. You just need to be clear about what it is, and that then feeds into what your exit strategy should be and what your exit strategy should look like. It's basically investing 101. Just before I go on to the American stocks, let's just look at a couple of charts just to illustrate. These are some of the charts that I was a bit surprised at, looking at what the indices did, what many high-flowing stocks that had gone up a lot in the prior couple of months, what they did. If you look at a stock like NVIDIA, which is obviously always gets plenty of airplay, this is Friday night. Now, okay, it looks a negative candle, but look at the volume. Given all the negativity around the valuation of NVIDIA, which by normal metrics is extreme, I would have expected, first of all, a worse result, a much bigger negative candle, but I would have expected volume, something like this, and particularly given options expiry, where you often see, in fact, you generally see quite extreme volume spikes. So that came as a surprise. Let's look at another stock that's probably the absolute poster child of hype, and that's a software stock called Palantir Technologies. Friday was not the bloodbath that I would have expected in this stock. It had gone up incredibly in a very short period of time. We had a massive gap here, and we then continued to trade up. And yet, look at what happened on Friday. There was a bit of a gap down Thursday, but Friday, again, is just not as negative as I would have expected. So I think it likely that this is a tap on the shoulder from the market about the valuations and the need to bring valuations down a few notches. And just one final one I would show, this is a stock called Pinterest. And again, there's no recommendations here. This is just purely using charts to illustrate the point. We'd had a significant gap up, a huge gap up, which is very, very positive. But in this sort of environment, I would have thought, and that candle looks really quite negative, looks ugly, and it may prove to be ugly, and the price comes back down here. I have no idea. But I look at the volume, and I look at the volume considering it was options expiry, it doesn't make sense to me. So it's possible that what we saw on Friday night in the last hour is just options expiry related. However, the US market wouldn't sort of grab on that as a reason to do nothing. The US market needed a valuation reset. This may well be it. So I would certainly proceed with greater caution from here. I think that's the key message. Let's look at American stocks. The S&P was off 1.7, the Nasdaq 2.3, the Russell down 3.6, as you would expect with small caps. And the banks and consumer discretionary were the worst percentage performers across the week. But nothing was really dramatic. Energy, healthcare, and surprisingly technology were near the top or at the top. And I would have thought in a valuation reset that the technology sector would be much more towards the bottom end of the totem pole, not closer to the top. So there's a lot of things about Friday that didn't make sense to me. It just doesn't feel, I've been in the market for nearly 4 decades, just doesn't feel like a major reversal to me. But, and this is the key point, if you own low quality stocks, it'll feel like a major reversal. The market will hammer low quality stocks. It may not happen overnight, but over the next few months, if you own low quality stocks, expect the price to trend down. Now, the US dollar was steady at 106.5 roughly. The 10-year yield eased a fraction to 4.43. And the VIX kicked up from around 14 up to 18. So let's go and look at some of the indices. But look, I don't think they're going to tell us very much, to be honest. You learn a lot more by looking at a few hundred charts and making your assessment of the market from there. So this is the S&P for the week. It was a short week anyway with President's holiday on Monday, but most of the damage was done in the last hour. So if we look to a daily chart, you can see it was really quite positive. There was a little bit of selling came in on Thursday, but it closed well off its lows. And Friday was holding up pretty well until that final hour. So make of it what you will, just be a bit more cautious. Now, if we look at the Nasdaq, pretty much the same. So we've come off all-time highs at the start of the week. It's not dramatic. It's not any worse than what we've seen over the last 3 or 4 months. So we'll just have to wait and see. Importantly, semiconductor stocks holding up really well. I would have thought in this environment with the trade wars, the uncertainty around tariffs, the whole tension between America and China, the semiconductors would be more out of favour than they are. So observations about the US market. The Aussie dollar was steady, just a tick under 63. Our index was down 3.1% for the week, and we had 5 successive down sessions. So it was a pretty negative week in Australia. The earnings season is getting a bit mixed and messy. Started off with some good results, but we're certainly seeing some softer outlooks now. The banks and the miners, banks got slammed. The finance index was down 8% on some, and I've put poor in inverted commas because the fundamentals weren't really all that bad, but the market reacted rather badly to them with Bendigo Bank and Westpac and NAB in particular. But when you looked at them, the results weren't really all that bad. I didn't think. Again, the banks had run so hard that this looks like a valuation reset. Now, that's happened before. In the last 6 months or so, we've seen 3 or 4 instances where the banks have been sharply sold off, and within a couple of weeks, they were back up and above to new highs. This time, it's more fundamentally based. The previous times, it was more of an overreaction. This time, the fundamentals have got a bit more bite to them as to why that may occur. And miners, of course, all the uncertainty, the iron ore prices is not helping. The copper price hasn't really improved, hasn't been able to consistently improve. And we always see this to a degree. But even more so, the market has zero tolerance for stocks that are reinvesting in their future, doing the right things, and that may impact 6 months or 12 months of their growth path, and the market is totally intolerant to that, which is pretty unfair, but it does create an opportunity to buy great growth stocks at a significant discount, and we saw a number of them during the week. Before I go into precious metals, we'll have a look at 6. All right, there's the Australian market for the week. Pretty sad trend of red candles. And I would expect that our market will gap down on Monday morning. However, how it trades from there will very much be dependent on to what degree Friday night in the US was an options expiry manipulation. So I'm going into Monday morning with a pretty open mind about how Monday may play out. It may not be that bad. Now, turning to precious metals, this is silver on a daily chart. We had a bit of a pullback in silver on Friday night, but if we put that on a weekly, I think you get a bit of a different picture here. We've now had almost 6 or 7 weeks to the upside. We've still got plenty of selling pressure, though. You can see these long wicks on the top. So there's still plenty of traders who want to come and sell into those sort of periods of positivity. This is the gold chart on a daily basis. You can see it did lose momentum towards the end of the week, but on a weekly chart, still yet another quite positive week. And we closed at 29.34. Putting that into Australian dollars, it just continues to soar. The Australian gold miners, the gold producers, are certainly producing a pretty penny at the moment. And we closed in Australian dollars at 46.15. I'll just show the Bitcoin chart quickly. So Bitcoin closed around 96,500 and has really just been trekking sideways since pretty much the November election. So an initial surge when Trump got in. There are a lot of other positives, which I'll get to in a minute, but has really just been trekking sideways now for a couple of months. So just to recap on precious metals, gold was up $53 to $29.34, 46.36 in Aussie dollars, and silver, this was about the most positive session we've seen in 5 months. Silver has been lagging what it would normally do relative to gold. So whether we're about to start playing catch up or not. But the one thing that did happen last week with precious metals is that there was the potential for a significant reversal. It had all the hallmarks where we've seen significant reversals start before, but there was no follow through and we ended up going up. So all you can say is that the gold market is extremely positive at the moment. Now, if we look at the local mining situation, mergers and acquisitions, particularly with some of the major players, is probably still going to happen, but it makes less sense now to be taking someone over when their share price is inflated. The numbers just don't work as well. I think a new trend that is emerging or could emerge is more of a merger of equals. A sharing of resources might be the new emphasis to give them forward progress. So that'll be very interesting to watch. Now, Bitcoin, there's quite a few positives. I think it's obvious now that what's happening with Bitcoin is more than just euphoria from Trump. We've got more institutional activity. That activity means more credibility for Bitcoin as an asset class, and that improves the liquidity. And that would appear now to be a cycle that is going to be extremely difficult to interrupt. A more regulated environment is going to be a huge advantage for institutions in how they see Bitcoin and cryptocurrencies as an asset class. And that's just building on itself. So I really see Bitcoin, and I'm very, very late to the party on Bitcoin. So I'm not telling you anything that you probably haven't heard before. I was a Bitcoin skeptic up until probably 6 months to a year ago, because I wasn't convinced that the demand would be sustained. We know about the supply. I wasn't convinced the demand would be sustained, but the institutional activity is something now, and certainly the environment under Trump is going to help. So I think Bitcoin's going to move, or is already moving, from a speculative asset to being considered as a mainstream financial instrument. There are still some negatives, of course. The extreme volatility swings is going to be a problem whilst it continues, and it's probable that it will continue. Will that settle down in the future? It's really difficult to say at this stage, but there's certainly a lot more positives around Bitcoin than negatives. If we turn to other commodities, copper was slightly weaker, $4.53, nickel still the same, just under $7. Trump still hasn't imposed tariffs on copper yet, but look, you've just got absolutely no idea what he's likely to do in the next 5 minutes. He's now making noises about a good relationship with China and better trade relations. He says anything as part of his negotiating tactics. So no one really knows how that one's going to play out, but it's certainly not as decisively negative as many people thought it would be. My view around copper, and this has been my view for years and years and years, this is not a recent thing. Don't look for uplift in the price of the commodity stocks that you own because the commodity price goes up, because then you have no control. Look for uplift in the price of what you own because it's a great project that is being developed, and the market will award a higher price because of the progress of that project. That way, you're controlling what is likely to happen with the price, not so much in terms of the timing, because that is unpredictable. But if you've got an absolutely world-class project that you've bought when it was out of favour, then it's highly, highly likely that you're going to get value uplift in that asset. But the project's got to be world-class. Management has got to be regarded as world-class for the price to go up in this sort of environment. Crude oil was steady, didn't really move much, 70.25. And as I've been saying for years and years, it's just a really tough sector. I personally haven't done anything in the energy sector for a long, long time. And just as an example, Woodside is now at the same price as it was in December of 2005. So that's 20 years. The share price is the same. Now, in the middle, there's been a massive amount of fluctuation. Let's look at it from a dividend point of view, because many investors will own stocks like Woodside for the dividend. In 2016, the dividend was $1.08 and a bit. The forecast for this year is for $1.27 and a bit. That's not much dividend growth. Now, admittedly, in between, there has been a huge roller coaster of share price and also dividend. There was 3 or 4 years there where Woodside paid a significantly higher dividend, but it also, during that period, paid a much lower dividend, half of $1.08. So from an investment point of view, unpredictable, not particularly attractive. And I just find that applies pretty much to the whole energy sector. That might be a bit harsh, but I deal in as much probability in growth as I can get, and the energy sector just does not provide that, in my view. There's the spot copper chart, maybe a couple of days out of date, but nevertheless, we've pulled back to the 450-ish level. So wrapping it all up, there's nothing new in effective investing, in smart investing, about getting above average results. The same general principles apply, so I'm sorry, I've got no new insight to offer anybody. It's so much about managing risk and clarity of thought. So to navigate this period that we're going to be in for the foreseeable future, and whilst Trump is in the White House, I think certainly for at least the next 4 years, to navigate this period of uncertainty and volatility, you've just got to be clear on purpose and process. And I know you hear me say this almost every week, but it's in talking to many, many investors, it's just something that hardly anyone takes the time to do. I don't understand. It's a pretty simple process. But you just got to be very clear on your purpose and your process, because that then informs what you should do when stock prices get very volatile to the downside. Do you panic and cut and run? Or do you hold on because you've got a quality asset and it's just going to go through a temporary blip to the downside? Unless you understand why you own something, you can't possibly make a decision or a clear decision about that. And it's really important to understand what your exit process looks like. Take your cues from the money flows, not the commentators, because they're just selling stuff. Portfolio analyst this week coming will be just a continuation of what's in there every week in some degree. And it's education and feedback from someone that's been in the market for 40 years, has made more mistakes than you've probably thought about, and just understands how the market works. It's the sort of things that you just do not find on the internet. So portfolio analyst is a very good vehicle for education, quite apart from the Q&A component of it. We're entering a period that's going to be tough. You need to make better, consistent decisions when things get tougher. So that's the important part about certainly the rest of 2025. I think there's going to be lots of great opportunities. Volatility is going to be challenging, but it's going to create the opportunities that you're not going to get otherwise. So embrace it. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.